Sometimes one sector of the stock market is up, other times it's down. And what do we do about this? Some investors believe that it's a great idea to switch their asset allocation periodically depending on what different sectors in the stock market are doing. Today, we're going to explore this idea a little bit and I'll share my opinion. Welcome to Stock Stories. All right. Welcome to Stock Stories, the show where we decode the business behind the stock. Hi, my name is Alex Mason, and I am your stock storyteller. And my wife and I went from not knowing anything about investing to becoming financially independent by 30 years old. And we did that by investing in the stock market. So that's why I'm here today, is to help you better understand companies and how they work, and also mental models and other investing concepts that are really useful for the investing process. And today we're going to get into a topic that I think is really interesting about sector rotation. So without further ado, let's get into the episode. Today we're going to talk about market sectors. Now, the stock market is a really big place. There are thousands and thousands of companies that trade on the stock market. And the thing is, each type of company is categorized in a different way. Years ago, people came up with ways to classify these stocks in different groups. Now, there's a standard system that has been developed to classify stocks based upon what groupings they're in, what types of industries and which types of sectors they're in. And think of stocks as existing within this bigger picture. You can imagine it like a tree with different branches. The trunk of the tree itself, that's the entire stock market. And then as it branches off, you have these other segments. So maybe the bigger branches are sectors, and then the smaller branches are industries, and then the leaves of the tree, those are the individual stocks. So that's kind of how I imagine it, is this hierarchy, this tree branching out, and you have these different categories. And the way that this is categorized is defined by the Global Industry Classification System, or GICS. So that's the way that stocks are classified. And we're going to focus today specifically on the sectors. All right, now if we imagine just the big branches of that tree for a moment, there are actually 11 different sectors of stocks in the stock market. They are consumer discretionary, consumer staples, energy, materials, industrials, healthcare, financials, information technology, or I like to think of it as just like tech, real estate, and communication services. And then the final 11th one is utilities. So no matter what company you're looking at investing in, it exists within one of these categories or sectors in the stock market. Those are just the 11 broad categories. For example, Apple would be in the technology sector, and then an oil and gas company like ExxonMobil, that would be in the energy sector. Now let's talk about sector rotation. So at any given time, certain sectors are up and certain sectors are down. Now I'm recording this right now in March 2022, and right now consumer discretionary is down about 14% for the year. Energy is up like 27%. So there's a big disparity in how these sectors perform at any given moment. And so the essential idea of sector rotation is that if you own either exchange traded funds, ETFs, or individual stocks in a bunch of different sectors, that you should rebalance them periodically in order to increase your performance. And let me explain what I mean by that. So let's say that energy is up, which it is right now. You would sell the energy stock or the ETF, and then you would buy the ones that are performing more poorly. So you would buy the stocks or the ETFs that went down and sell the ones that went up. Over a period of time, you would repeat the process. Energy is now down and consumer discretionary is now up. So then you would sell the consumer stocks, buy the energy stocks. And so you're constantly buying and selling depending on performance of these different sectors over time. Why would you do this? Why would you even think about this kind of a strategy? Sectors that underperform at a given point in time tend to go on to outperform later. And sectors that overperform at a given period of time they tend to underperform in the future also. So, in a way, you're trying to play the different elements of the market cycle by selling and buying periodically. If you know the concept of reversion to the mean, that's basically what you're doing. You're kind of trying to smooth out your returns and increase them over time by selling high and buying low, is effectively what you're trying to do. Okay, so if you wanted to do this, how would you actually do it? Well, there's these different ETFs that are sector related ETFs, and they're called spiders, SPDR. And that's the active way to do it. You buy a basket of these ETFs that represent each sector. For example, there's one that's called XLI. XLI, that ticker symbol, it represents industrials. So if you were to buy that ticker symbol, that represents a holding of a bunch of industrial companies. Likewise, XLV, that represents healthcare. So if you bought that ETF, you would own companies like Johnson and Johnson, United Health, AbbVie, different healthcare companies. Now, the good thing about these sector ETFs is that they have low fees, somewhere around 0.1% per year. So that helps a lot with the trading costs of buying and selling. Now, there's also an automatic sector rotation ETF out there called XLSR. That's a ticker symbol for that one. And if you buy that ETF, you'll have automatic sector rotation by the company that's managing that ETF. So you don't really have to do anything with that. The problem with that one is the fees are higher at around 0.7% per year. So you're definitely paying a lot more to have that automated for you. Another thing about this ETF is that it's only been around since 2019. So there's really not a lot of data yet to prove whether or not that particular strategy works for that specific ETF. Some final thoughts on this. I don't really know if it's worth it to do sector rotation because whether you're choosing individual stocks or sector spiders, like I just mentioned, you're basically trying to time the cyclicality of the market, which is really hard to do. I mean, sometimes you might be able to get it right. Like, for example, if oil is crashing and you're like, okay, oil won't be crashing forever, I'm going to buy an ETF for the energy sector and then watch it go up in a year or two. That might work out for you, but it might not. It's really hard to predict these things as an individual investor. Even if you're really knowledgeable about certain sectors of the economy, it can still be difficult. Now, that being said, some investors do try this approach, but for me personally, I won't be doing sector rotation. I'd much rather understand individual companies, either understand individual companies and buy stock very selectively, or buy an index fund and just say, I'm just going to own the whole market and just buy and hold. So those are the two main approaches that I personally like at this time. So I'm not a big fan of sector rotation for those reasons. Now, if you've enjoyed this episode, go ahead and tap that like button for me. Thank you so much in advance. I appreciate you listening to and watching this episode. And that's all I got for you today. But I will be back later with more episodes, and we're going to be going through more companies in the S&P 500, more mental models, and talking about more topics in the stock market. Thank you so much, and I'll see you next time.